Imagine you are in your late 20s, excelling in your career. Your managing director has begun to step out during your presentations, clearly having confidence in your analysis, which allows you to rest easier than many of your peers. You are responsible for mid-cap industrials at a lesser-known asset management firm in Chicago, where your fund manages assets worth $4.2 billion spread across 60 investments. You personally hold shares in 8 of those. Each day you arrive at the office before 6, turning on your 3 monitors to sift through earnings reports, commentary from management, and sell-side updates that often lack substance. You believe the market serves as a platform for price discovery, and your role is to identify when that process breaks down. However, soon, this belief will be challenged. On a Tuesday in October, just before the market closes, your phone rings. The number isn't familiar. A calm voice on the other end belongs to a man named Garrett Whitmore, from a family office managing $3.1 billion in private assets. This family owns 22% of a company you cover, Arden, one of your 8 holdings, and wants to meet before Friday's earnings call. You agree to go, ending up at an unmarked office in the West Loop. After using a key card for access to the elevator, you find Whitmore, a man in his mid-50s, sporting silver hair. He pours 2 glasses of water, sets a folder on the table, and inside you find your last 3 quarterly notes, on Arden meticulously annotated in blue ink. It's clear someone has studied your work closely. Whitmore shares that the family acquired Arden 11 years ago for $412 million, and now it trades at 31. However, they have no plans to sell, even with its 600% return. When you question why they wouldn't sell, suggesting basic portfolio management, he scrutinizes you as a chess player would a novice who has misplaced a piece. Whitmore explains the tax implications: federal gains at 20%, net investment income at 3.8, and Illinois state tax at 4.95, translating to roughly $80 million in tax on $280 million of unrealized gains. You suggest that's simply the cost inherent in realizing gains, but he counters it's a cost they choose to avoid. He then pushes a term sheet across the table proposing a lending facility of $190 million at an annual rate of 3.4%, with no tax repercussions. This strategy enables the asset to grow without being liquidated. You find yourself silent for a while, as Whitmore states, "Our goal is to ensure we never need to find another security again." You accept the engagement, though you don't yet grasp the depth of his perspective. This marks the beginning of your education. The first year is about mastering the technical aspects. You focus on the family's portfolio structure rather than typical asset allocation. They utilize real estate through various LLCs, each as a separate legal entity. Equity holdings are managed within a trust designed to increase the cost basis upon death, completely shielding heirs from taxes. There's a stake in a private credit firm, where carried interest is taxed at favorable long-term capital gains rates. Each asset is strategically selected not just for return potential, but for tax efficiency and leverage utility. This isn't simply a portfolio, it's a sophisticated apparatus engineered for sustained spending power while avoiding the taxation that typically accompanies asset sales. One night at 11, you modeled different scenarios in solitude at the office. In one, the family sells Arden, pays the taxes, then reinvests at an assumed annual return of 8%. In another, they borrow at 3.4%, keeping the asset to let it appreciate. After projecting both for 30 years, the disparity in outcomes is staggering: $340 million more for the borrowing strategy. Despite identical return rates, the critical distinction is their choice not to incur unnecessary costs. The calculations are glaringly obvious once realized. You momentarily question why such knowledge isn't taught more widely, but then you stop. You understand that the system is built to safeguard these strategies. In your second year, Whitmore introduces you to another family, one with generational wealth relying on networks that operate through exclusive channels: toll roads, a water utility, and a cell tower portfolio. Their assets not only appreciate but also generate cash flow regularly, independent of market fluctuations, a concept they refer to as permanent income, which cannot be halted. During a meeting, the family patriarch is presented with an enticing offer for the water utility, valuing it at 12 times EBITDA, with an implied price of $680 million. However, he doesn't inquire about the buyer or the valuation. His sole question is about the available borrowing against it. When informed the figure stands at $290 million at 4.1%, he concludes that it's sufficient for their upcoming project, and thanks everyone for their time. In that moment, you grasp a critical lesson. To him, the offer is inconsequential. Selling represents closure, an exit. Every asset serves as a lasting claim on productive resources. To sell one equates to exchanging a permanent stake for a fleeting sum of cash, which is subject to taxation, potential misallocation, or squandering. Wealthy individuals refrain from selling, understanding that it represents a detrimental move for any productive asset. Your perspective shifts. Initially, you approach transactions with an exit mindset, but you leave with a notion of permanence. By your third year, you move beyond observation to construction. You work with a tech entrepreneur holding $1.4 billion in a single stock, unable to sell without a substantial market crash and a significant tax burden. You create a structuring solution leveraging exchange funds to defer gains entirely. The process stretches over 4 months, and legal fees eclipse $2.4 million. Upon completion, you receive a call from the founder, who, from a boat, expresses a sense of triumph for maneuvering the situation better than most people recognize as possible. Your understanding of leverage evolves. It is not merely a risk factor, it is a strategic instrument. Wealthy investors consider collateral quality rather than portfolio volatility. An income-generating piece of real estate has value not just for the rent it collects, but also as security for credit facilities at 50% loan-to-value ratios. Each asset doesn't stack up but forms a complex lattice, with each investment bolstering the others. Selling one diminishes the collective strength of the whole. Then, in your fourth year, you are discreetly called upon to provide guidance during a restructuring. An activist shareholder pressures a publicly traded holding company to liquidate its real estate. While the activist is correct about valuations, you now find yourself on the opposite side. The controlling shareholder holds 41% equity across 2 family generations with a negligible cost basis and embedded gains amounting to $940 million. Selling would incur a tax burden of $260 million on top of relinquishing an income stream of $38 million per year indefinitely, and the forfeiture of control over 3 office markets for the next 40 years. That influence isn't captured in figures. It represents structural power compounding in ways that dollars cannot measure. You conceive a defense mechanism, a recapitalization involving a leveraged dividend that allows capital redistribution without necessitating a sale, providing the activist with partial liquidity without full divestment. Ultimately, the activist agrees to let the family retain its assets. Whitmore acknowledges your growth, stating, "You understand now, and you do. The city blocks remain firm, the income persists, and the game elevates to a higher level. The truly affluent avoid selling because every transaction represents an irreversible loss." Genuine wealth is rooted in the commitment to neither diminish nor relinquish assets that are actively generating income and serving as collateral, contributing to compounding value. Unlike cash, which is static and taxed upon arrival, assets are dynamic. They do not cease generating income simply because their owners experience disappointing quarters. Sophisticated owners borrow against these operations to fund acquisitions, benefiting from interest rates lower than their asset yields. The tax code is not a static entity. It varies in response to structural strategies. Families that sell face financial consequences, while those that borrow do not. Those who retain their assets until death pass them on to heirs with a stepped-up cost basis, meaning the government never gets a share of the gains. This isn't evasion, it's a strategy to preserve wealth and ensure long-term financial stability. As you navigate through these intricate lessons, remember that there is much more to discover. If you're intrigued by this journey into wealth management and financial strategies, make sure to subscribe to Billy Finance for more insights. This is the realm of architecture. Every affluent family with a rich history has an architect to guide them. However, for many, the existence of an architect is unknown. Your connections have significantly decreased, but their value has surged. Most interactions have shifted towards performance rather than authentic dialogue. It's become challenging to discuss your true endeavors in many settings. The divide between your knowledge and what can actually be expressed has solidified into a constant internal struggle. Currently, you're engaged in a venture larger than any you've previously undertaken. A proposal has emerged, estimating its worth at $2,800,000,000 with an embedded gain of $1,900,000,000. Depending on the structure, the tax could range anywhere from $380 million to $560 million. You are navigating both liquidity and tax deferral along a delicate path. The legal framework involves three different jurisdictions, and the IRS has been monitoring for the past 18 months. 3 weeks ago, a comparable structure at a different family office faced scrutiny, and its results remain uncertain. You are constructing something that may not stand firm, yet you proceed. It is woven into the family legacy, spanning 4 generations with a clear policy. We do not sell. Tomorrow, the markets will open and the tax council will provide feedback in 3 weeks. The exclusivity of the consortium will expire in 6 weeks, and you possess the blueprint. However, you do not have ownership of the toll roads or the city blocks. Another family is poised, waiting for their turn, holding another position and another potential gain. The game continues onward. Before we wrap up, don't forget to subscribe to Billy Finance. I appreciate your time and feel free to leave your thoughts in the comments below.